Options trading verticals, your size, and how to roll the options. Let me know your thoughts about whether you prefer to trade verticals or naked options. You can leave a comment below. Again, let me know your thoughts whether you prefer to trade naked options or verticals, and also why. If you want to volunteer that information, then that would be great. You can also go to BestStockStrategy.com and enter in your email address and receive over $400 worth of free training materials. Those training materials are better than many people's materials that they actually charge you for. So in this video, we're going to discuss spreads, which are also called verticals, and the size that you should trade, and additionally, how to roll and manage that position. So I'm going to try to keep this very simple because I go in very detail. I go in a lot of detail in my course, and I don't want to be disrespectful to the people who purchase the course. So as a result, I'm going to be extremely superficial in the amount of knowledge that I provide in this video, so that way the people who purchase the course are able to derive substantial value from it. But basically, the biggest mistake that I see people do when they trade spreads is that they trade too large. Remember that when you trade a spread, the primary reason that you're doing so is not necessarily to turn an undefined risk trade into a defined risk trade, because for the most part, the times that you're actually going to use, let's say you're selling a put spread, the number of times, or the percentage of times that you're actually going to utilize that put that you bought is extremely low, maybe 1% or so. The primary reason that people are going to end up trading spreads is because it provides a higher return on capital, and it allows you to have more capital efficiency. For example, let's say you're going to sell a $1,500 put on Amazon. That is then going to require you, if you sold it naked, around $60,000 of buying power reduction, because remember, the buying power reduction is calculated as 20% of your maximum loss. So if you sell a $1,500 put, or rather $30,000. So if you sold a $1,500 put, then it would be $150,000 would be the notional value, the maximum loss per contract, and then 20% of that would be $30,000. As a result, your buying power would be reduced by $30,000. Now, if you trade a spread, let's say you were to trade, you would sell the same $1,500 put and you would buy the $1,450. That's a $50 wide spread, and as a result, you would only have a buying power reduction of around $1,000, and that's calculated because you have $50 multiplied by 100 shares. That would be $5,000, and then of maximum loss, and 20% of that would be $1,000. So there's a major difference between $1,000 deduction and a $30,000 buying power reduction, and that's the primary reason that people choose spreads, is that it provides a higher return on capital. The problem with spreads is that a lot of people trade too large. If they are able to trade, let's say, 2 or 3 naked options, instead what I see people do who end up losing money is they will trade 20 spreads, and that's not something that you want to do. You do not want to trade 5 or 6 times the number of contracts that you could possibly trade as a naked option, and you don't want to trade 5 or 6 times more spreads just because of the greater capital efficiency. Going back to the Amazon example, remember, selling the spread in that specific example is 30 times more efficient. That means that from a buying power perspective, you could technically sell 30 1,500 by 1,450 spreads for every one 1,500 naked option that you sell, and realize the same buying power reduction. The problem with that is that if the market has a bad week and it starts approaching that $1,500 strike, your broker is going to force you to close out those positions because you're going to have a tremendous amount of exposure. Now, in the worst case scenario, if Amazon actually falls below 1,500 and it starts trading around 1475, then you're going to be in that no man's land where it's going to be below the short put that you sold and above the put that you bought, therefore causing the 1450 put to essentially be worthless. Yes, it's going to provide you some downside protection, but if the stock price ends up in the middle, then you're not going to be afforded any type of, because you can't afford to take ownership of that stock, and because you traded too large, you're probably not even going to be able to roll and manage that position. your broker is going to force you to close out that position. You're going to be in a margin call and you're going to sustain massive losses. I can't tell you enough how many times this happens. Remember, your goal should always be to make less money when the market is going well so that you can lose a lot less money when the market is doing poorly. For example, during 2018, between like March and September, everything was going great. During that scenario, you should have actually been taking on a little bit less risk and maybe earn like 1% less a month, because that would have set you up and that would have established positive habits so that when October and December rolled around, you lost a lot less money. Because you never want to be in a situation where you have a month or you have a sequence of events where you lose so much money that it takes you 6 months or a year to recoup that money. So again, you want to get in good habits, and I know that you want to make as much money as quickly as possible. Everyone does. But I'll tell you that the losses hurt a lot more than the gains feel good. And you want to make sure that if you are trading spreads, which is completely fine, that you really don't trade too many of them. This is something that I teach in my options trading course, in the education course. You can go to beststockstrategy.com/memberships and enroll to be a member. We go in much greater detail regarding the specific ratio of spreads to naked options that you should sell. We also get into rolling. Rolling a spread is very difficult. So I do get into some strategies in the education course, but the primary reason for making this video is I wanted to tell you that you have to make sure that when you trade spreads, you do not give in to the desire to try to make quick and easy money and you don't trade too large. Because in the example that I gave previously, when you sold the 1500 by 1450 strike on Amazon, that transaction, the way that you structure